Now, Aaron, do you want to take a look at the question from a listener on the inverse relationship of bond prices to bond yields? I believe that was the question, was it not?
Yes. So
Something in that
we
respect.
received a question from one of our listeners, saying that he would just like a breakdown on why bond prices would decline when interest rates rise, because a lot of people just looking at it quickly would think like, well, aren't higher interest rates better for bonds, but not for existing bonds. And this is something that I think is important for bond investors to at least get a bit of a grasp on. Last week, I think it was, I did a talk on the yield curve, and then Brennan just blasted me. He basically said that my charts,
Sorry.
my graphs, they were too confusing. So then he pulled up some
Rightfully
fancy
so. Yeah.
data visualizations and animations, and but it got me to thinking. I'm glad that he did. So what I did is essentially to illustrate this point. Is on the weekend I used my coding skills and built a little app that is going to help us. Let's see here. That is going to help us visualize how changing interest rates will affect bond prices, and also changing years to maturity as well. Right. Okay. So say you're going to buy a bond, right? Say you bought a bond a year ago, right? And it was a 10-year, so 10-year government bond, and it was yielding 2%. So we're going to put 2 in here for 2%. So you got your bond here, right? Say it's $100 bond, just as an example here, 2% interest rate. So that means that for every $100 that you invested, you're going to be getting annualized interest payments of $2, right? And these are typically semi-annual, so it's going to get paid twice per year, but annualized $2. And that's what you get. And this interest payment is fixed over the life of the bond, which in this case is 10 years. So no matter what happens, you're going to get that 2% annualized per year over the 10 years, and then you're going to get your $100 returned at the end of 10 years. But then, something happens. Interest rates rise. Maybe they rise up to 4%, right? And then you look at your bond. It's like, oh, my bond was worth $100 before. Now it's worth $84. And so the question is, well, why did my bond decline in value? And the reason for that is that, yes, interest rates rose. They doubled, in fact, from 2 to 4%. But bonds are a fixed income investment. So you're still, on the bond that you purchased, you're still just getting that 2% annualized interest payment every year, right? So if you're just going to hold that bond, you could argue that it's not really that relevant. But maybe you're in a situation where you want to sell the bond, and you can't redeem it, right? Because it's that bond is going to exist. Like the person who issued the bond, or the government that issued the bond, isn't going to redeem it. But there is a liquid market for most government bonds, right? So you could take it to the market. You'd be like, I actually need the money. I want to sell this. Now your bond that you bought at a 2% interest rate that is paying $2 annualized per year has to compete with other bonds that are issued at 4% and are going to be paying $4 annualized per year, right? So in order for you to basically incentivize somebody to buy that bond, you need to sell it at a lower price so that they can get that same yield, right? So the way that this is calculated, the change in a bond price based on interest rates, it can be a fairly complicated equation. It's essentially, it's called duration. And I'm not going to get too much into duration, but duration basically tells you, how much your bond is expected to decline in price for every 1% change in interest rates. So what I did here is I used present value method, which is pretty close. It's giving you a pretty close assessment, right? But essentially, when the interest rates go up, new bonds are issued at those higher interest rates. And now if you want to sell your bond, well, then you have to essentially sell it at a lower price in order to compete. Now, the opposite could be true. What if interest rates declined to 1%? Well, then all of a sudden you're doing great, because if you want to sell your bond that pays $2 per share annualized, or $2 per bond annualized per $100 face value, you're now competing against bonds that are only paying $1 in interest payments annualized. So you're going to get a premium on that bond. So when interest rates decline, your bond now looks better relative to the new bonds being issued. So your bond is going to trade at a premium. But when interest rates increase, your bond is going to get worse relative to the current bonds. So your bond is going to trade at a discount, right? So interest rates, rising interest rates are one of the biggest risks of the bond investor, essentially. Now, you could argue that if you're not going to sell your bond, if you're just going to hold it to maturity, then at the end you're going to get your $100 back, that this doesn't really matter. What it really does represent is the opportunity cost, right? So if you're holding a bond, a 10-year bond, and then interest rates rise the next year significantly, you're stuck with that low interest rate, or you could sell your bond at a discount. It's not like you're losing money technically, but there's the opportunity cost. If you didn't invest all of your money in that bond, you could have, waited a year and then got bonds at a higher rate. Of course, nobody can predict the future. Now, as your bond gets closer to maturity, this becomes less of an issue. So, started at 7 years, maybe your bond, maybe it took 3 years for interest rates to double, right? So, $84 is what it would have been if interest rates doubled right away. Your bond price would have declined to $84. But if it was 3 years, it would have been less of a decline, down to $88. Now, if you're 1 year away, there's very little interest rate sensitivity, right? Because the biggest income payment that you're going to get is your principal back at the end of the term, right? So if you're only 1 year away, you have a couple interest payments, you're going to get your $100 back, or whatever the face value of the bond is. So a short-term bond has very little interest rate sensitivity. However, a long-term bond, like say if this is a 30-year bond, well, that has a major interest rate sensitivity, right? Because it's a long time before you get that principal returned. And then all of those interest payments that you're getting, which is the reason why you own the bond, are coming to you at points in the future. So when you're discounting that value back to present day, it makes a big difference, right? Now, if the time to maturity is 0, which basically means that your bond is up, you're going to get your money back, then it's always going to trade at par, right? It's going to trade at $100. Doesn't matter what the interest rate is. The interest rate could go up to 20%. Not saying that it will, but that essentially means that it's time for you to be repaid. So you have no interest rate sensitivity. So the point here is that, yes, bonds are interest rate sensitive. That sensitivity also depends a lot on the time to maturity. So longer term bonds are going to be more sensitive. Shorter term bonds are going to be less sensitive. If it's like a 1 year bond, there's very, very little sensitivity. That's essentially the way that a bond works, right? So a lot of people think of bonds as very safe investments. And if you hold the bond again to maturity, it's not like you're going to lose your principal. You're going to get it back, but there is that opportunity cost. But if you're investing in a bond ETF, they have to own a wide range of bonds. They always have bonds expiring. Then they have to reinvest that money. So there is volatility in the price of an ETF, a bond ETF portfolio. And what I did is I pulled up BMO bond ETF ZAG. So this is a very safe bond ETF. It invests mostly in Government of Canada bonds. And you can see that it's down almost 12%. This was for 2022. So actually more than the stock market. So we think of bonds as being safe investments, but this very safe bond fund is actually down more than the stock market. And the reason for this is because interest rates went up so high. So this ETF owns bonds that were written years ago when interest rates were really low, and they have to hold on to those bonds until maturity or sell them at a discount when interest rates go up. So they're essentially in a situation where now they're holding a bunch of low interest rate bonds, while new bonds that are being issued at higher interest rates, right? So it makes their current bond portfolio look less attractive. Thus, the price of those bonds have to go down in order to make the yield go up to the market rate. Now, this will reverse if interest rates stay at a high level for a period of time. As their bonds expire, they will invest in the higher interest rate bonds. And then if interest rates start going down again, you'll see the opposite effect. The value of their bond portfolio, it will trade at a premium because their average rate will be higher than the current market rate. But that's essentially how it works. Hopefully that makes sense. So I don't know, I could maybe like throw this little widget online or something if people wanted to play with it and just see how the bond price changes based on the maturity and the and the interest rate.
Very cool.
Good.
Yeah, you know what I would have done there? Actually, I would.
Nobody
Just
cares,
kidding,
Brennan.
Aaron. I'm just
Nobody
bugging
cares.
you. I'm only joking. Excellent job. No, excellent job. Great visualization. I might need that to help me study up for the next level CFA here eventually.
To get to the next level.
Yeah, to get to the next level. Yeah, no,
that I'm sure Dave will be happy with that. That's a good representation, and visually, it's good to look at it like that. So anybody watching on YouTube, for anybody on the podcast, that was completely useless, Aaron. So come on, I'm kidding. Anyways,
No, it's
on
great.
the podcast, it'll look great for everyone. Not on the YouTube show, it'll look great for everyone. That's what I'm trying to say. I don't know what I'm saying.
Good. Well, as I said, if anybody is interested, if you want me to throw it online so that anybody can access it and play with it, then just throw a couple comments on the YouTube channel or wherever you access the podcast.
Yeah, and we can post
email us.
it.
If there's some interest, people want to play around with it, I'll put it up.
Awesome.
Good. Okay. Well, let's. That's it for that segment. I'm going to look at your stock, our take segment on